What's going on, guys? Joshua here. So in today's video, I got a really good one for you. We're going over the 6 best monthly dividend ETFs. That's right. The ETFs on this list don't pay dividends every quarter. They pay dividends every single month. And so I picked out 6 of the best ones, in my opinion, that will pay you the highest dividends so that you can get the most bang for your buck. So let's go ahead and not waste any more time. Starting at number 6 is DHS, or the WisdomTree U.S. High Dividend Fund. This ETF seeks to track the investment results of high dividend yielding companies in the U.S. stock market. So in other words, you don't have to waste your time anymore going out and researching and trying to find the highest dividend paying stocks, because this ETF already does that for you. And so by purchasing shares of this ETF, you're automatically giving your portfolio targeted exposure to the highest dividend paying stocks in the US stock market. For example, out of the 315 stocks that this ETF currently holds, some of its top holdings include companies that you'll likely recognize, such as Pfizer, Cisco, Verizon, AT&T, and Coca-Cola. And because this ETF holds some pretty solid companies, it also means that the performance is also pretty good. Over the past 10 years, DHS has given an average annual return of about 11.57%. This means that if you would have invested $10,000 into this ETF 10 years ago, your investment would have grown close to $30,000. And that's on top of the high dividend yield that this ETF offers, which comes in at a 3.77%. Now, for an ETF that pays a dividend this high, and this is not even the highest on this list, we'll go over some others that pay even better, but for an ETF that pays a dividend even over 2%, it's really surprising to see that it's grown this much over the past 10 years. Now, you may be thinking to yourself, Joshua, a 3.77% dividend yield is not that impressive, right? I've got stocks in my portfolio that pay as high as an 8% dividend yield. So for example, you could go with a stock like National Presto Industries, which has a 7.48% dividend yield. And while yes, that dividend is certainly pretty mouthwatering, the growth of this stock has been extremely depressing as told by the 5-year chart here. And this is a classic example of a value trap, or it can also be called a dividend trap, where the dividend yield is super high, but the stock or the ETF is actually losing value over time. But enough of all that, let's go ahead and talk about the risk level of DHS as well as the expense ratio. On a scale of 1 to 5, with 1 being the least risky and 5 being the most risky, I'm going to give this ETF a 3. And then in terms of the expense ratio, it's not like the cheapest ETF in the world, but it's also not the most expensive. With an expense ratio of 0.3%, you can expect to pay $38 per year on $10,000 invested. Generally speaking, I would say that anything that falls below a 0.5% expense ratio would be considered a cheaper ETF, whereas anything above that would be on the more expensive side. So DHS falls under 0.5%, so it's a little bit cheaper to own. DHS is a fantastic monthly dividend ETF, and I think it's a really good choice for any income investors. However, it is only number 6 on the list, which means we have 5 others to go over, and theoretically it can only go uphill from here, so let's keep on pressing forward. So coming in at number 5 is SPHD, also known as the Invesco S&P 500 High Dividend Low Volatility ETF. SPHD is based on the S&P 500 Low Volatility High Dividend Index, which is an index that measures the performance of the 50 least volatile high dividend yielding stocks in the S&P 500. This index was basically designed as a benchmark for investors looking to earn income from their investments, and because SPHD was designed around the index, it's pretty safe to say that it's a really solid choice for your dividend portfolio. SPHD currently holds 51 stocks in total, with top holdings in Iron Mountain, ExxonMobil, and some other potentially less familiar companies. This ETF was founded in 2012, which means that we can't actually look at the 10-year performance of the ETF. However, since its inception, you can see that this ETF has had a yearly return of about 11.03%. This means that $10,000 invested back in 2012 would be worth a little bit over $23,000 today. Again, considering that this is a high yield dividend ETF, it's really impressive to see that your investment will experience good capital appreciation on top of the high dividend that you're receiving every single month. And speaking of dividends, this ETF will pay you a monthly dividend of 3.86%. And by the way, if you aren't completely familiar with what the dividend yield means and how that translates into money into your pocket, I'll explain that a little bit later in the video, so make sure you stick around and watch until the end so that you can see what that means and how that affects you. Morningstar rates this ETF as a 3 on the risk scale, and considering that it only invests in low volatility stocks, I think 3 is a fair rating. The expense ratio comes in at a 0.30%, which means you'll be paying $30 per year on $10,000 invested. invested. If you are an income investor or somebody who's looking to potentially live off of your dividend payments, then SPHD is without a doubt a really solid option for you. However, so are the other 4 on this list. Next up at number 4 is PGX, or the Invesco Preferred ETF. PGX seeks to track the performance of the ICE Both AML Core Plus Fixed Rate Preferred Securities Index. I sometimes wonder who comes up with the names of these indexes and if there is any way that you could make the name a little bit more creative. But in any case, this ETF is a market cap weighted index designed to measure the total return performance of the fixed rate US dollar denominated preferred securities market. Now that sounds pretty dang confusing, but it basically just means that PGX only invests in shares of preferred stock. Preferred shares are a special type of stock that pay a set scheduled dividend that's very similar to a bond. However, they're unique from bonds in that by owning shares of a preferred stock, you still have ownership of or part ownership of the company, whereas with bonds you don't. Preferred shares of stock are also known for paying out higher dividend yields when compared to common shares of stock, which is what like 99% of retail investors invest in when they're investing in the stock market. PGX currently holds 301 preferred share issues with top holdings in Citigroup, JP Morgan Chase, Wells Fargo, and many others. Over the past 10 years, PGX has returned about 6.73% per year. This means that $10,000 invested into this ETF 10 years ago would be close to $19,000 today. And on top of that, you'll also earn a dividend yield of about 4.87%. The expense ratio on PGX is slightly higher, coming in at a 0.52%, which means that you'll pay $52 per year on $10,000 invested. And because this ETF invests in only preferred shares of stock, it does carry a little bit less risk and therefore comes in at a 3 on the risk scale. All right, moving right along, at number 3, we've got DIV, or the Global X SuperDividend U.S. ETF. Very similar to the number 5 ETF on this list. The only difference between number 5 and this one is that this one, DIV, invests in low volatility and high dividend paying stocks within the entire U.S. stock market instead of just the S&P 500. DIV holds 50 of the highest dividend yielding stocks in the U.S., with top holdings in CubeSmart, Public Storage, Pfizer, and others. This ETF was founded in 2013, which means it's relatively new, and so we can't actually track the 10-year performance of it yet. However, since its inception in 2013, it's given an average annual return of about 4.67%. And while the growth of this ETF is a little bit slower than the other ones on this list, what it lacks in performance, it makes up for in its high dividend yield. DIV has a dividend yield of 5.80%, which is the highest one on the list so far. But it's also bordering the line of having a high expense ratio, coming in at a 0.45%, which means you'll pay $45 per year on $10,000 invested. I think it's a pretty fair assessment to say that some of the other ETFs on this list could potentially be better investments when compared to this one. However, the main criteria for ranking these ETFs on this list was the dividend yield. And so the higher the dividend yield, that means the more money in your pocket each month, which for income investors is their primary focus. And so although DIV has a smaller annual return and it also has a higher expense ratio, it also has a higher dividend yield, and that's why it falls higher on my list. In terms of where it falls on the risk scale, I'm actually going to place DIV at a 5. I think that the combination of this ETF only investing in 50 companies as well as the low returns and the higher expense ratio makes this ETF a little bit more of a risky option, especially when compared to the other ETFs on this list. So we are quickly approaching the end here. We've got 2 more on the list, and these last 2 are going to pay out some of the highest on the list. I think you'll be really impressed with what you see, so let's keep on moving forward. Coming in at number 2 is SDIV, or the Global X SuperDividend ETF. Yes, you might recognize this ETF because the last ETF was DIV and this one is SDIV. This is a very similar ETF made by the same company with a slight twist to it. The difference with this ETF is that instead of investing in 50 of the highest dividend yielding stocks in the US, it actually invests in 100 of the highest dividend yielding stocks in the world. Now, the actual number of stocks that the ETF holds currently sits at 104, with top holdings in China Power International, Yanzhou Coal, I'm not sure if I pronounced that right, and some other names that you likely won't recognize. Over the past 10 years, this ETF has only returned about 3.10% per year on average, which means that $10,000 invested 10 years ago would be worth only about $13,600 today. And so even though your hypothetical $10,000 investment is not losing value, it's still not growing as much as it would be if you were to invest in, say, a growth ETF or even something like VOO. However, like I've repeated in different ways multiple times in the video so far, typically what you lose in capital appreciation, you're gaining in the dividends, right? The two are sort of working in an inverse relationship. The more dividends you earn, the less capital appreciation of that ETF or of that stock you'll experience. But if you're investing for income anyways, that should be fine for you. As long as the ETF or the stock is not losing value over the years. For example, if you were to invest $10,000 into an ETF and then 10 years later your $10,000 was worth $5,000, well, that would be a problem, right? So as long as it's either staying relatively stagnant or going up a little bit and you're still getting those high dividend payments, then that should be okay if you are an income investor. Speaking of dividends, SDIV currently has a dividend yield of 6.83%. And like with all the ETFs on this list, it does pay a monthly dividend. In terms of risk, because this stock invests heavily in international stocks, which often exhibit greater volatility than US stocks, I'm going to have to give this a 5 on the risk scale. This ETF has an expense ratio of 0.59%, which is definitely on the more expensive side. It means that you'll be paying $59 per year on $10,000 invested. And last, the number one monthly dividend ETF on the list is KBWD, or the Invesco KBW High Dividend Yield Financial ETF. This ETF is based on the KBW NASDAQ Financial Sector Dividend Yield Index, which is a dividend yield weighted index consisting of U.S. financial companies with high dividend yields that are usually engaged in the business of providing some type of financial product or service. This could be something like banking or insurance or loans or something along those lines. This ETF only holds about 41 stocks with top holdings in some names that you likely won't recognize. All of these are financial companies that provide financial services and products. Now, although this ETF's performance will never be able to compete against like Cathie Wood's ARK ETF or anything like that, it's still a relatively good performing ETF, especially for something that pays such a high dividend yield. The current 10-year average sits at about 8.75% per year. This means that $10,000 invested 10 years ago would have grown to around the upper $19,000 range. However, where this ETF really shines and why it sits at number one on the list is its super high dividend yield, which currently sits at a juicy 7.37% according to Invesco's yield performance details. However, that high yield definitely comes with a price, and that price comes in the form of a significantly higher expense ratio than all the other ETFs on this list, with a 1.24% expense ratio. That's more than double the cost of the most expensive ETF on this list, SDIV, which had an expense ratio of 0.59%. In terms of risk, this ETF is currently a 5 on the risk scale because it only invests in 41 companies, and they're all financial companies whose performance will vary based on the interest rate environment in the US. And so yes, while this ETF certainly does have the highest dividend yield of all the other ETFs on this list, it also has the highest expense ratio, and it comes with some other risk factors as well that should be worth considering when deciding which of these ETFs to choose for your investment portfolio. Okay, now I want to transition and talk with you for a moment about the actual dividend yield and what that means for you in terms of money in your pocket. Like, how can you look at the dividend yield and determine the face dollar amount that you're going to receive based off of that dividend yield percentage? Let's talk about that. The first thing that you should know is that stocks pay out dividends on a per share basis. And so let's say, for example, you've got a stock that pays a $2 dividend and you own 10 shares of that stock. Well, that means that you're going to receive $20 per year worth of dividends. Now, if you actually wanted to find the exact dollar amount that you would receive per share of stock that you own based off of the dividend yield percentage, there's actually a really easy formula that you can use. And so I'll put it up on the screen here. So all you do is you take the dividend yield percentage. So we'll use KBWD as the example. So this ETF has a dividend yield of 7.37%. So we'll take that 7.37% and we'll divide it by 100, and then you times it by the current price of the stock or the ETF. And so in this example, KBWD at the time of this recording is currently trading at $20.41. That's the current price of the ETF. So dividend yield divided by 100 times the price of the stock or ETF. Hit enter, and that'll give you your actual face dollar amount that you'll earn per share of the stock or ETF that you own. So for KBWD, you would earn roughly $1.50 in dividends per year per share of the ETF that you own. Now, that may not sound like a lot of money, right? And if you only own one share of this ETF, then yeah, that's not a lot of money at all. If you divide 150 by 12, you'll earn less than like 12 cents or something per month in dividends. But the idea is that you want to own as many shares of a dividend ETF or dividend stock as possible. So for example, let's say that you own 1,000 shares of KBWD. Well, that would be $1,500 per year in dividend payments, right? And then if you wanted to see how much you would earn in monthly dividends, you would just divide that number by 12. So 1,500 divided by 12, I believe, is 125. And so that's $125 per month in dividend payments that you would be receiving. That could easily go toward a bill or two, depending on your lifestyle, depending on the things that you're paying for. That's not bad. And if you wanted to increase that monthly dividend, you would obviously just go and buy more shares of the dividend stock or of the dividend ETF to increase the amount of dividends that you're earning each month. This is how people live off of their dividends. They own so many shares of a dividend paying stock or dividend paying ETF that they're able to comfortably live off of the dividends alone. So I hope that you found some value in this video. If you did and you have not already hit that like button, please do me a huge favor and tap the like button. It would mean the world to me. Also, if you like content like this and you have not yet subscribed to my channel, subscribe, turn on the bell notification so that you can be notified whenever I do post. I appreciate you guys sticking around until the end. It means a lot to me. And as always, I will see you again very soon. Take care.